What's going on, everybody? It's another week of What the F Happened. We're out here in Palm Beach at a conference, and I'll tell you, we just listened to one economist and one CEO of a very large, giant mutually owned insurance company. They gave us the lowdown on what is going on in the markets, and that's what we're going to talk about today. How much is the Fed going to raise rates today? Is it going to be 0.5%? Is it going to be 0.75%? What's that going to mean to you? Well, I'll tell you what that means, because the mortgage industry is already jumping rates almost a full interest rate. So a full percentage point, that means your houses are going to get more expensive. That means real estate's going to start going down in the markets. Do I really need to tell you what they're doing? These are some of the things we're going to talk about today on What the F Happened. Stay with us. We'll be right back. All right, welcome back, everybody, to another week of What the F Happened. Today, we're going live from Palm Beach. Mr. Snaggy and myself are out here for a conference, and he'll be joining us in just a second. But, let's get into the specifics about what is going on in the markets and what the F happened. Well, it's quite simple. We've been talking about this for a while. Fed actions, Fed actions, Fed actions. Inflation's out of control. It just went up again. And now the Fed has to take aggressive action. And they've made it very clear they're going to take incredibly aggressive action to make sure that they bring inflation back down. But is it going to work? Well, if you talk to the experts, the answer is not fast. It's going to take time to bring this crazy, out of control inflation back down, because you got some unforeseens in there. You got Ukraine-Russia war, Russia-Ukraine war, whichever way you call that. You've got all sorts of shortages when it comes to embargoes, when it comes to all the different sanctions the U.S. put on Russia, so we're not buying oil from them. The EU is also slowing down oil purchases from Russia. So there's a major shortage of oil, which is why the price at the gas pumps is going up, on top of many other things like greed and government, stopping. Well, we won't even go there. But your gas prices are going to go higher, much higher. I wouldn't be surprised that sometime this summer, if we don't see $9 to $10 a gallon. Can you imagine thinking about that? Yes, 9 to 10. They're using it as an initiative to push all these electric cars, but the infrastructure can't even handle everybody having an electric car. So where's the give take in that whole thing? I'd love to hear what you guys have to say about that. What's up, Silver Bullet? What's up, Alan here? We got everybody kind of jumping on to it. We got all sorts of stuff to cover today. So where should we start? Well, let's start with the elephant in the room. Let's start with today. Let's start with what the Fed action might be today on interest rates, because we know the Fed is raising interest rates 7 times this year. We've already had 2 increases. Today, there's going to be another announcement about another increase. So if you want to talk about what's baked into the pricing in the markets, why has your stock? Oh, and also the thing I want to be clear is this month, folks, all of you get your statements for your 401ks. You guys are all going to get your statements for 401ks. You're also going to get statements for your investment accounts. That's right, folks. They're coming, and you're not going to like them. You're not going to like them at all, because those statements are going to be down. How much? Well, for the year, depending on what you're invested in, the markets are down 20%. That's right. 4 more increases in Canada. So Alan's coming in here from Canada, and he said there's 4 more increases in Canada. You see, what happens in the U.S. isn't always confined to the U.S. Other countries follow suits. Other countries are going through the similar problems we are. Runaway inflation. COVID and the pandemic created all sorts of issues. A lot of governments across the world printed money, and therefore, when you print a bunch of money and keep interest rates low and make money easy for everybody, there's this thing called inflation that happens. Sorry. I mean, when you print $1, it takes value from the current dollars in circulation. When you print 5.1 trillion, it takes an awful lot of value away from your current dollars. So your dollars simply buy less. It's a hidden tax. That's what inflation is. Inflation, everybody wants to point fingers and say inflation is the fault of this and fault of that. Listen, inflation is a component of easy money. Easy money in the tune of 5.1 trillion. Easy money in the fact that we've had low interest rates for far too long. The Fed reacted way too late, and they've admitted it. Yellen has come on and said that we waited too long. We made a mistake. We thought it was going to be transitory. No, it wasn't. But that's the things you're dealing with today, and they're not going to slow down, because you know what else is going to happen? Pretty soon there's going to be food shortages. Technically there already is, but there's going to be more food shortages. And when those food shortages kick in, that might not be so fun, because wheat, something that's in almost everything we eat, one of the major number one, I think they're number one, if I'm not mistaken, exporters of wheat is Ukraine. So now we don't have that. What is that going to mean? Well, that's going to be rough, folks. That's going to be rough. So get ready. Get your house in order. Stock the pantry up. Get some canned goods. Make sure you get it before it's hard to get. You remember what happened during the pandemic? If you were looking for, toilet paper, or how about bullets, all that stuff, you couldn't get them. Well, now you can, but maybe not for long. How about mortgages? Let's talk about that. As the Fed makes these decisions, one direct thing that's being affected when the Fed raises interest rates is the cost of money. So if you borrow money, it just got more expensive. But where's the place that it's hitting the hardest? Real estate. Why? Because real estate right now is in a very speculative bubble. I would argue, and now you guys don't have to believe me on this, but I'm going to argue that right now, real estate is probably in a bigger speculative bubble than we were in 2008. I want that to sink in. Okay. 2006 and 2007, real estate was out of control. Out of control. If you guys don't remember that, I certainly do. Price of real estate was going up because everybody had easy money. Everybody could go out and get a mortgage. Now, some of the problems were fixed with Dodd-Frank and some of the other things that happened due to the 2008 Great Recession, but those problems weren't all fixed, because the same things are happening today. But yet a lot of people out there say, oh, it's demand. It's demand. There's not going to be a slowdown in real estate. Real estate prices are still going to keep going to the moon because there's so much demand. The millennials want houses and there's not enough of them. True, true, and true. But let's get to actually the things that matter. There might be a lot of demand, but there's a pendulum. And the pendulum has turned the wrong direction. So now there's a ton of demand. And the demand is from a ton of people that can't afford the price of the houses today. Now, maybe they could afford it last year. Maybe they could have afforded it the year before when interest rates were low. But if interest rates on a 30-year mortgage now are approaching 6% and probably will go over 6%, mark my word, if it's not already there, it will go over 6%. When you raise interest rates on a mortgage, you decrease the amount someone can get. That's just mathematics. It's how it works. So if you're going to tell me there's enough demand to support pricing going up still, I'm going to call your bluff. And I'm going to tell you there's two things you're not factoring in that. Number one, the millennials and all the people that want to buy houses, they simply are not going to have the means to buy the houses at today's prices. That's number one. Number two, investor confidence, investor sentiment is going away quickly. People are getting scared. Crypto's down around 20, or Bitcoin's down around 20,000. Everything else is following Bitcoin down. Bitcoin, Ethereum, all of the cryptos are correlated directly to the market. So when the markets go down, crypto goes down. Why? People are like, oh, I didn't think they were correlated. I wonder what's going on. Tell you what's going on. Investor sentiment. People are losing faith. They're getting scared. When fear comes into the market, you start losing investor confidence. You start losing the VIX. The VIX starts going out of control, which is the volatility index. And all of a sudden, now you got yourself a problem. Because when one gets scared, the next gets scared. Statements are coming out. They're going to be down 20+%. Mark my words. If you haven't been listening to us about how to reposition assets, you're down over 20%. I don't know what to tell you. We just went over this the other day with an economist. Actually, it's over 20%. Yesterday wasn't exactly a banger day in the market either. It opened up, finished down. What are you going to do about that? So Paul came in and said, he's just saying thanks. But Alan said, I remortgaged right now on a rate hold from March. That was smart. He got in on probably the last good rate holds you're going to get. let's see. I just want to kind of come to some of the questions here because we got lots of them coming in here on TikTok, and I don't want to disregard them. So let's see. House prices are going to plateau. We got JRZ or sorry, JRZ Shore Broker. Colorado conservative said Dave Ramsey, my buddy, just said home prices won't go down. They will just rise slower. He said buy. Now, Colorado conservative, and he's on here a lot. We talk, but like, when is that dude going to realize he is a joke? Like, really, Dave? Buy? Really, Dave? Oh man, he is something else. Thanks for that comment, Colorado. Let's see what else we got. Your payments will be double what they should be when home prices being up and rates being high. Absolutely correct. So that's the thing you got to understand. When the rates go up, which they are today, the Fed might raise rate. So it's baked in at 50 basis points, 0.5%. But there's a very strong possibility the Fed might go 0.75 of a point. They might go 75 bips on this increase. That will be bad for the markets. The markets were up last time I checked in anticipation of the Fed's news and what they're going to do. If the Fed comes out and does a 50 basis point increase, I don't know, the markets could rally, which would be it'd be great for some of you. It might give you that little bump you've been looking for to kind of exit. Some of you that own crypto are probably looking for a little like increase. Well, I know we all are. I bet you many of you aren't thinking that crypto and Bitcoin is going to go to 65, 70, 80,000 like you did a month ago. It still will, but how long is it going to take? 3 years, 5 years? I mean, who knows? It's anyone's ball game, but it's a scary place where it's at right now. Now, it's funny. We talk about all the places where you could have hid, all the places where you could have actually just taken money and put it where you'd be safe. Now, even those places, treasury bonds, like I talk about a lot, the 30-year ZRAs, zero coupon bond, all those things, they're down too. But they're down, and I told you they're down. They're supposed to be down. When rates go up, what happens to bonds? Bond prices go down. So that creates a buying opportunity. Rates going up, bond prices are going down, you buy the bonds. Because then when rates go back down, when we enter this deep recession, which we are in bear market territory right now. So once we enter there, the Fed, after they raise the rates to get a hold of inflation, they're going to destroy the economy, which is going to destroy the markets. And then all of a sudden, what are they going to have to do? Bring the rates back down. Normal monetary policy. It's just what they do, folks, because that's how they stimulate it. But you can't stimulate a market when interest rates are as low as they are. And right now, they'd have a hard time pushing through more money printing. Say they're printing money for Ukraine, but they're not going to probably get through printing more money because they just blew the nut on the 5.1 trillion they printed during the pandemic, which was probably excessive. Did it work? Yeah. Did it work too well? Well, look at the gas pumps, look at the food. Now, gas, I understand, is one that you could kind of discount. You could say, yeah, Chris, gas isn't because of 5.1 trillion that was printed. I'd agree. It's more because of the Russia-Ukraine war and supply and demand. So that's part of it. Same thing with food. But even if you strip those out and you get to the core CPI, you still got yourself a big old ass problem, folks, because I don't know if you looked, okay, how much are eggs? Okay, that's food. But how much are the shirts that you buy at the store? How much is everything? The refrigerators, the washing machines, everything's crazy right now. So even if we strip oil and gas out and we get to the core CPI, got a problem, folks. Still got a problem. Right here, Alan from Canada said the next rate increase for Canada is July 13th. They're looking at a 75 basis point increase too. So you can see the U.S. sets the precedent. The Fed sets the precedent. And a lot of times other countries, Canada, which is technically our neighbor, they will follow suit. So there you go. No problem, Mike, long as you're here. So let's go to a couple more questions. We're going to change topics here because there's a couple things I really want to hit on. Home prices are going to continue. So right here, we got Arthur Comer said home prices are going to continue to rise, maybe not as fast, but they will continue to rise. Everybody's entitled to their opinion, Arthur. I'm not going to sit there and say that you're wrong. I'm going to say the likeliness of you being right is probably a lot less of the likeliness of me being right. And the fact that I think price of real estate is going down, it's not going to continue to rise, especially if the Fed keeps doing what they're doing. Okay. Not only is the Fed raising interest rates, Arthur, the Fed is also sucking liquidity out of the market to the tune of about $90+ billion a month. Okay. 90+ billion. They haven't started the 90+ billion. I think it's 95 billion. They're going to start doing the unwinding of the balance sheet. So Arthur, rates are going to go up, which is going to definitely stunt real estate pricing. It's not going to just make it rise slowly. It's going to drop it, because if the demand is there and all the inventory on the market is at a high price where we're valued, the only way the demand is ever going to be fulfilled and the sellers are going to be able to sell their house is to bring that price down. The pendulum is switching. So Arthur, I'd call your bluff. I'd say you could be right, because you're basing it on demand, which is there, but demand is going to go away because of investor sentiment and the inability for the demand to be able to afford the pricing today. So that's where you're at. But I appreciate your comment. Jay Holland said 2/3 of the buyers in Florida are cash. Yeah, so that's a great one. Jay Holland, I want to really hit this. Thanks for that comment. That's a great one. I'm in Florida right now, and a lot of my team is in Florida. So I'm very in tune with what's going on in Florida. Now, I will say Florida and Texas are kind of like the two, like they're almost insulated from some of the things that are going to happen with real estate, primarily because political reasons. A lot of people want to move to Texas and Florida. It's kind of like the last great frontier, whatever you want, which is driving the price of real estate. But let me go to, Jay Holland's comment about the fact that most buyers in Florida are cash. You have to look at, where is that cash coming from? Do people really just have stockpiles of cash? Well, for the most part, like the middle and upper class do, but that's going to start going away, because as markets go down, a lot of their cash is coming from assets. Okay. And let's define assets. Stocks. How are stocks doing? They're down 20%. So let's take that one off the table. How about crypto for some of the younger folks and the younger, tech-based investors that were, riding high on it, driving the Bugattis and the Ferraris and Lambos because of their money they made in crypto. How's that looking? Yep, that's off the table. So let's take that off. How about real estate? So right now they're still pulling money out of real estate. So where is the cash coming from? Well, I can tell you exactly where it's coming from. A lot of the cash that is being used to buy the properties is because people have sold other real estate in the bubble. They've sold out of one piece of real estate and they're looking to buy another, but they have cash because they had so much equity. So a lot of the cash that you see in these cash buyers are one of two things. One, the tail end of this cycle. Okay. People that have sold houses, people that have sold assets that have cash, that will dissipate soon. That will be gone soon. Second thing that this cash is smoke and mirrors. They're putting cash on the application or on the contract saying they're cash buyers. They're maybe showing that they have assets through proof of funds, maybe from a hard money lender or a private lender, or maybe somebody transferred money into their account. So you have to discount some of that cash is smoke and mirrors. The rest of it is just the tail end of the cycle. But thank you for your comment. So rates aren't high, people, get real. I love that. So Lexicon Free said rates aren't high. They're absolutely correct. Rates are not high. Historically, we're still in the lowest interest rate cycle we've ever been at, but we've gotten so used to being in an unrealistic, unsustainable, unscalable, low interest rate market that everybody thinks that this is normal. They think, rates below 3% are normal. Folks, that's not. Lexicon right here on TikTok is absolutely correct. Rates are still very low, but it doesn't matter whether rates are low or high. What we're talking about is the dynamic of the rates where they're at and the increases in the rates and the impact that that's going to have on real estate, because the price of real estate is so speculative. Even if you factor out all the things and you just really boil it down, the price of real estate right now is out of control. Okay. We've looked at the numbers. We've had an economist tell us that, here's the price of real estate, backing all these things out, adjusting it for inflation. You're still in a bubble, folks. So that's going to be a difficult thing. Yep. Colorado said Bitcoin hit 20,000, down from 69. Can't say we didn't say that was coming. Let's see. We're barely over 30-year average of interest rates. That's Lexicon coming back in. 100% correct. Someone made a comment here on BlackRock buying up everything. So if you really start looking at who's buying and who the cash buyers are, this is what I think they're talking about. The cash buyers, a lot of them that you're seeing out there, especially in Florida, Arizona, Texas, Salt Lake City, those cash buyers, do you know who they are? They're institutions. They're BlackRocks. Okay. They're hedge funds. They're not individuals. They're not you and me coming in cash, unless we're just kind of playing with cash from a property we sold. These are the things you need to be aware of. Like smoke and mirrors. Cash might be there. There might be cash buyers, but they're not people you want to live next to, because they're institutions buying your neighborhood, and they're doing it at a very high rate. They have more cash to burn right now than you'll ever know, and it's a problem. So let's come over here and just hit some of these questions we've got on the forefront of YouTube. So let's see, we got a couple YouTube coming in. Stephen Nagy's here. I sent him the link. For some reason, it didn't work. Like I said, we're doing this remote. So let's see, open the blinds up. It's beautiful. But if I open the blinds, it kind of drowns me out. But we'll try that for a little bit. So yeah, it is beautiful out. We're you guys can't really see it, but we're sitting on a beautiful, beautiful ocean view here out in Palm Beach. I don't know if you guys can see this, but I'll just kind of show it to you here. So that's the balcony. You guys got the ocean right there. We spent lots of days sitting out in that ocean. It's been a ton of fun, and I just can't wait to get home, though. It's been a long time. I've been on the road since Tuesday. We were in Aruba, and then we flew to Palm Beach, and today's the last day. So let's see. Alan said, would you dollar cost average in weekly or monthly on those bonds? I'd probably say either one, Alan, would be good. I mean, you could dollar cost average in monthly. That'd be probably safe right now because, Fed actions. I've just been watching the price of TLT and ZROS, which are the two ETFs that I've been buying. I've just been watching it. When I see it dip for one reason or the other, I buy a chunk. Like the other day, I bought another 5,000 of each one of them. So I just dollar cost average in on kind of just emotion. And when I'm looking at it and I see it going down, because it's going to continue to keep going down, I'll just keep taking positions as it goes. Because when the whole thing lets loose, which might be sooner than we all thought, okay, when the whole thing lets loose, believe me, after the Fed gets a hold of inflation, they're going to have to control the recession, and that will be done by monetary policy, and that always involves lowering rates. Let's see. King Crum said, let's see. How will it affect people who stuck with variable rate mortgages? Do you think it will cause foreclosures? Of course it's going to cause foreclosures. Of course. I mean, variable rate mortgages or ARMs, you're definitely going to see issues there, and there's a lot of them. I know a lot of people were using those in the low interest rate cycle. So banks are going to raise those rates. People probably won't be able to afford, but that might be another 6 to 8 months before you even see any of that come to light. And even when the foreclosures come, I'd have to say, kind of knowing some of the things this administration does, they're going to try to help bail that out, or at least prolong that, at least to the election time. They don't want, on their watch, they don't want a whole bunch of people foreclosing on their houses, because that's not going to be good for votes. Does that make sense? Ethan said, how long do you think it will be until the Fed starts dropping rates when things crash? How high do you think the rates will get for the HELOCs, mortgages, before it drops again? What's your guess? All right, so these are great questions. Ethan coming in here from YouTube. So let me try to kind of break that down. And we just heard from an economist that kind of gave some insight on exactly what he's asking. So how long before the Fed starts dropping rates? Well, when we actually enter a recession, which is 2 back-to-back quarters of declining GDP. So once we actually can confirm we're in a recession, that is usually when they will start taking some action. But this time will be different, because the Fed is in a head-on collision, a war with inflation. So the Fed's going to take care of inflation first, because that's the thing that they're really focused on. Inflation is not going to be what they want for the dollar. Okay. And it's also what you don't want. Okay. You want deflation, but the Fed doesn't want deflation either. The Fed kind of just wants this nice harmonious balance of a 3%, inflation, CPI, as they would call it. But what you want is deflation. You want asset prices to go down, but you got to be ready for it. So the first thing is when do we think that will be? Probably sometime end of 2023. That would be my best guess. And it is simply a guess. You cannot time the markets. So because I can't time the markets, I can't time the Fed action on when they'll bring rates down. The soonest would probably be sometime late 2023 for that. Second part of his question is he's asking, let's see, before it drops again, what's my guess on, the HELOC mortgages and all that? How high do I think rates will get? So there's two schools of thought. Some people, literally, and this is crazy, some people think we will see rates, because of Fed action, as high as 6%. I think that's a bit aggressive. Okay, I think you might see rates go somewhere 3.5. Okay. And I'm talking about Fed rates, folks, not the rates you guys see in your mortgages. I'm talking Fed funds. Okay. Probably 3.5. That would be a guess. Okay. 6 would be the tail end of the spectrum of like, holy shit. And if it got to 6, fucking the ship has hit the bottom of the ocean. That's all I'm going to tell you. So that would be my guesses there. What's up, Drew? We got Russell coming in. He's saying, I have a feeling that corporations are going to keep real estate artificially propped up since they're the ones coming in, buying cash homes blocks at a time, and they want real estate unattainable for average people to inject them into the renter's world. Everything will transition to subscription-based society. You'll own nothing and be happy. So Russell's got some points there. I don't think the court. So it's a valid point, but I don't think the corporations are going to be able to hold that thing. I think they're going to try, and I think he's right. The corporations will try to hold the price of real estate up. But you got to understand another thing, Russell. These hedge funds, okay, these institutions don't really care if the price of those assets go down, because here's the thing, and this is a very important thing for all of you to take away from this, okay? The Fed, well, sorry, not the Fed, the institutions, the BlackRocks, the Blackstones, all the ones that you've heard about, buying your neighborhoods. There's two schools of thought. They're buying real estate, and they're going to rent that real estate, cash flow. But on the books, they can book that real estate as an asset, and they can book it at a pretty high valuation. Valuations of real estate will fall, but they will fall far less than the valuations of stocks. So equities will fall a lot more than real estate. So on the books of these giant hedge funds that have trillions, okay, trillions of dollars, definitely hundreds of billions to play with combined, okay, on the books, real estate is still a better play than any of the equities or any of the bonds. And they know this because real estate can provide cash flow. Real estate will drop less than the other underlying assets that will definitely be deflated. So they don't care if the price of real estate goes down. They really don't. So why would they prop it up if they don't care if it goes down? Because it's going to go down less. That when you talk to institutions, okay, I don't care if it's insurance companies, hedge funds, whatever, Wall Street, we'll just call it. The way they look at money and decreases is different than you. When you look at your portfolio go down, okay, you get scared. Institutions will say, well, we're down 20%, but the overall markets are down 30. We're doing really good. We're 10% better than the market, the mark to market. Okay. But like, that's not the way you look at it. You're like, oh my God, we can't retire. We can't do this. We can't do that. Institutions say, we can play the long game. We can wait. We're 10% better than the overall markets. That's a win to them. And they're down 20%. If they're down 20%, but the overall market's down 30, that's a win to institutions, Russell. So you got to factor that in. Even though real estate values will go down, institutions will be, well, it's better than what the overall markets are. That's how you got to play that one. So hopefully that helps a little bit. Grubbs over here on TikTok seems to think it does. Let's see what other ones. James kind of made a really good point there. Plus, with the Fed raising rates, it'll allow them to kickstart the economy again during the recession, kind of what we keep talking about. The Fed has to get rates up so they can pull rates back down. It's just the natural cycle of it. But the Fed will stop at nothing to fight this inflation battle, because that's what, well, there's many factors as to why that's happening. Some political, some US dollar. Mostly for the Fed, it's protect the dollar. I want all of you to understand something. The Fed has the best product on earth. It's the US dollar. Okay. The Fed's number one job, and you should write this down and remember this. The Fed's number one job. You ever want to know why the Fed does things? Remember this. Their number one job is to protect the dollar. Bar none. That is the number one thing that they are going to do. And they will go to any length for that. They will go to war to protect the dollar. So if the dollar gets challenged by the yen, if the dollar gets challenged by any other currency, just know the Fed, the US government, they're influenced by the Fed heavily. They're not owned by the Fed, but they're influenced by the Fed because the Fed owns a lot of debt. And that debt is the US government debt. So therefore, the Fed, to the tune of about $8.9 trillion, has leverage over the US, and certainly, and in the past has done this, could force us into a war so that they protect the dollar. Just saying, that's bad shit. It's not doomsday stuff. It's realistic. It's happened before, but it's stuff you need to be aware of. Let's see. Kevin Kelly, what's going on, Kevin? I haven't seen you in a while. Chris, you know a little bit of a hell of a lot. Glad to know you. Trying to get to Buffalo. Had a flight for cheap. Let's see. Then the app blew up. Try later. Yeah. So thanks, Kevin, for that comment in there. And also what Kevin's talking about there is we've got an event coming up. Okay. At the end of July 30th and the 31st, or you can come join us for the VIP event, which would be the 29th. That's going to be epic. So any of those dates, get out to Buffalo, New York. Buffalo, New York is beautiful. We're putting on an awesome event. We rented a TV studio, so there'll be like a Letterman show. We've got all sorts of unbelievable speakers coming in. If you're interested in that event, it's very easy. Just go to Money School REI. And what I'm going to do is I'm actually going to type this in. So if anyone is interested in coming to the event, the VIP tickets I know will sell out pretty soon. So if you're interested in the VIP event, make sure you get on that. But it's very easy to register. I just put the link up, moneyschool.com/July-event. Okay, so if you guys want to come to the event, I just put that in there. Definitely worth your time, because we're going to go into these things in depth. How to protect your money, how to preserve your money, how to make money in a recession, how to literally come through this recession that we will be in probably inside the next quarter, how to actually thrive and make a shit ton of money during a recessionary period. Like if you want to learn that, come on out. And if you can't make it, you can't get a flight. Like, Kevin was saying, he doesn't know if he's going to be able to get a flight. Join us virtually. We're going to be having Stephen Nagy doing a whole separate virtual presentation of the live event. It's going to be epic. So whether you can come or can't, grab your tickets right away at Money School REI or moneyschoolrei.com/July-event. July-event, I think, is the better way to say that. Let's see, I'm just going to hit a few more questions, then we're going to move on to the very next topic. Let's see, could the economy be driven by political war between Dems and Repub? It's a tough one. I mean, the economy, I don't think the two sides really is what's driving some of these issues. It's more Fed action. So, but, is the Fed action maybe being influenced, or, are the Republicans or the Dems being influenced by Fed action? Yeah, I'm sure. It's about elections. Okay. It's about votes. So never discount that. But right now it's truly the economy is being affected solely by Fed action and inflation. Those are your two big things that you're looking at this present point. If the Fed gets up to 3 or 6%, what would you translate that for the average HELOC mortgage interest rate? All right, that's a great question. Ethan from YouTube came in and asked that. So the Fed raise the Fed fund rates to 3, what would that mean for your mortgage rates? Probably 6.5%, maybe 7%. If the Fed gets them up to 6, double digits. If not double digits, high singles. That's all I'm telling you. You're seeing it happen right now. So it's kind of fun. Here's a little exercise you could do just to prove that point. So just go back to last year and look at where a 30-year mortgage was, and look at where the Fed funds rates were before they started raising rates. Now look, we're only 2 rate increases in, but you'd have to bake in a 50 basis point increase for the third, because the market's already built that in, and so have mortgage rates. Where are rates today? We were just talking to Devin Burr's wife. She's in the mortgage industry with Quicken Loans, and we were just talking to her. Rates are over 6% right now. 30-year fix is over 6%. And we've only had 3 of the 7 increases. And that the increases started at 25 basis points. Then they went 50. Today, we might see 0.75%. So it's very realistic, but it's very, very much going to affect the price of real estate quickly. So real estate usually is a 6 to 8 month lag behind the markets. The markets have been falling all year. So start counting. When the stock market started losing steam, technically all year, but let's just say February, March, okay? Go 6 to 8 months from there. That's when real estate's really going to start feeling the burn in the pinch. It's always a lagging indicator. All right, let's see. Let me come over here to TikTok. Colorado conservative said 18% mortgage rates back when Reagan got inflation under control. Absolutely correct, because they took massive action. So Colorado conservatives talking about something some of you are too young to remember, but us old guys and gals remember these times. So back in the late 70s, early 80s, we had hyperinflation. Crazy. You might have heard your parents talking about the lines at the gas pump. You might have heard your parents talking about how their savings account used to earn them 10%, which doesn't matter that their savings account earned them 10% because their mortgage was probably 14 to 18%. So it's a give take. It doesn't matter if you make 10 when you're paying 18, right? It doesn't matter if you're earning nothing and you're paying 3 right now. It's the same thing. It's all parallel. But we remember those times and how much impact they had. And what Reagan and that administration and the Fed did then is took massive action. It definitely hurt the economy. It led to a very big recession, which I talked about at the Wealth webinar last week. And if any of you want to learn more about this stuff, every single week we do the Wealth webinar every Wednesday at 1 p.m. I won't be on today, but we've got a great speaker coming on today to talk taxes. But every Wednesday we're doing that. On YouTube, I put up videos every week, every single week. So every one of you listening on TikTok and also over here, please subscribe to my YouTube channel. It's at The Chris Naugle. I put videos up every week talking about this stuff, but not just talking about it, giving you tactical action steps, just like we're going to go over at the live event July 30th and the 31st. But you can go to YouTube and get really great content that dives deep into this, because today we're just brushing the surface based on what's in the news. But it's all great stuff. Russell said, all wars are bankers' wars. Listen to that, folks. TikTok, I want you to really listen to that. What's going on from New Zealand? Man, New Zealand's got some crazy shit going on, but I love it. It's one of the most beautiful places. So let me hit Russell here. He said, all wars are bankers' wars. Do you understand what that means? This is very important, folks. Very important. Every war is a banker's war. Wars are started usually because of bankers. And who are we talking when we talk to bankers? Well, let's just land at the central banks and the Fed. They fund wars, folks. Okay. Where do you think the money to fight a war comes from? The Fed. The Fed prints money. The Fed then trades that money for bonds. I don't care if those bonds are our bonds, okay, the U.S. Treasury bonds. I don't care if those bonds are, European bonds, Japanese bonds, China bonds. Like, that's all the same thing. The Fed, the central banks, fund wars. It's a very profitable thing for the central banks. So if the Fed's number one job is to protect the dollar, is a war in line? Don't discount it. And it's very scary when you start hearing this president, okay, this president who has no business being our president, going on talking, blaming. That's all the dude does is blame. And listen, I don't care if you're Democrat or Republican. I think it's very safe. Like, let's take away all of the, one side or the other, the divide in this country. Let's just take that away. Both sides, Democrats and Republicans, they're both a bunch of liars and they're both bullshit. But let's get down to one thing and let's try to just agree to disagree, or just agree. This president should not be running this country. When you think of a leader, when I look at any corporation, I look at any solid leader of a company or any organization, the leader does one thing really well. They solve fucking problems. Okay? They solve problems. This president, our leader, okay, our president, Joe Biden, does one thing: blames everybody else. Blaming doesn't solve problems, folks. Blaming is votes. He's trying to win votes. So hopefully it's not working. And I'm not saying Democrat, Republican, doesn't matter. Let's just put that on the side. Our leader shouldn't be leading this country. He's weak. He has no clue what he's doing. He's definitely not making and calling the shots. And all he does every time he's in front of that TV is blame this, blame that, blame this, blame that. And half of it makes no fucking sense. So I don't care if you dislike what I just said. That's a fact. Take away Republicans or Democrats. You just talk about the leader of any company. If that dude led any company, he would have been demoted and fired within the first month of taking that position. No ifs, ands, or buts about it. Getting back. So there we go. Yeah. And what am I babbling about, dude? Well, open your fucking ears. You got a mask on in your picture. So, we know where you did. You probably voted for the bumbling mess up there anyway. Not even going to get political on that one. But it's just at this present point, listen, politics are not something I'm an expert in. I don't talk about it on this show. But at this point, that leader that we have in this country, I'm not even going to give his name, should not be leading this country. He's doing a terrible job. And he's taking away so many things that too many of my friends have given their life to protect. And that is called our fucking freedom. And there's way too many of our servicemen. And thank you. If any of you on here are servicemen or women, if you served in the Army, the military, the Marines, anything, all I want to do is take my hat off and say, thank you for your service. Thank you for the ultimate sacrifice, the ultimate thing, which is everything comes around our freedom being protected. And that is on the chopping block, folks. And I've just lost way too many friends. Way too many friends in Iraq. Way too many friends have died fighting for that freedom that we literally, some of us take very seriously, but I don't think this president takes freedom very serious, but I do. So that's where I draw the line. Anyway, let's get back into it. Let's see. What else do we got? What's the last war that actually protect the American freedom? Yeah, Ghost Stalker Gaming and Beats. That's a good, that's an interesting one. What's the last war that actually protected our freedom? Well, we know it wasn't Vietnam. Okay, Iraq. You can definitely say that might have been protecting our freedom. You'd have to really, really kind of, siphon out the bullshit, siphon out why we went to war. Probably, in my opinion, World War I and World War II. We were fighting for our freedom. Okay. Now, you could argue that, I'm sure, but that would probably be what I would say would be that. The Cold War and a lot of the things there, definitely, fighting for freedom. But if you just strip away, what was the last war that we actually fought for freedom, you really just kind of have to look at and strip that away and look at our military men and women. They're always fighting for our freedom. Whether or not the actual war is truly being fought for the right reasons or not, they fight for our freedom. That's it. That's all that matters. So let's see. I'm a mother who gave 2 sons. Yeah, see right there. I mean, M. Ford 4. How many mothers, gave the ultimate sacrifice, which was their loved ones. I mean, it's a tough thing. It's a really tough thing for me. I mean, it kind of almost brings me, to tear up here. But it looks a lot like this government wants to force us into this war with Russia, Ukraine, whether it's right or wrong. It's just a hard pill for me to swallow, because I look at it as not our war. Are there reasons we should be involved? Are there reasons we should help them fight for their freedom in Ukraine? I'm sure you can make a point for all of that. But should our young men and young women, should our husbands and wives go to fight somebody else's war and give the ultimate sacrifice? It's not our war, folks. But again, you could look at all the other wars and say they weren't our wars either, but we were thrust into them. Yeah, when Japan attacked Pearl Harbor, clearly that thrust us into the war. When planes hit the towers, conspiracy or no conspiracy, and all that stuff happened, yeah, that became something where now it was our war. And too many people gave the ultimate sacrifice. And I know most of you on here know people that have. So thank you, M. Ford, for coming out and saying that. And, I would thank, your husband and your children for their service and for protecting our freedom. I really would. Let's see. What else do we got? Stop Russia. Not sure what that means, Blaine. Let's see. Do you have any advice for starting up an automatic detailing LLC and being my own bank while doing so? Yeah, a lot of advice. So if you want to, that's a good business. The auto detailing. My friends, I got 2 friends, John and Ryan. They started an auto detailing out of this tiny little garage, and now they've got this ginormous business. They do all the detailing. They do all the ceramic coating for all the dealerships. These guys are making millions of dollars, and they started in a one bay garage, one of those ones where you'd go do hand washing. They rented one of those bays, and that's where they started their detailing. And today, and it's a short period of time, probably 7-8 years later, they have a giant business. So the first thing to do is set up the structure. You probably want to set up an LLC. It's probably the easiest structure for you to do. So you can get a hold of someone like Corporate Capital. I could connect you with them. Corporate Capital is great. They set up all of our LLCs. Make sure you get your some knowledge in how to run a business in terms of bookkeeping. You want to make sure you have books and records. And how do you use the banking system to do that? The infinite banking concept, easy. That will fund your initial equipment purchases instead of using a leasing company or a bank. And then you can then pay yourself back out of proceeds from your business. That's how I would do it to keep it nice and simple. Techno77 said, you don't know a damn thing about war and dying. You're right. I've never died and I've never fought in a war, but I've watched friends do that. So I appreciate your comment. I don't know really where you're going. I'm not trying to sit here and say I'm an expert in that. I'm just simply saying that we have a lot of people fighting for our freedom and we need to fight for it as well. Is Bitcoin going to recover? Yeah, I think so eventually. I think Bitcoin will recover. Keith coming in from TikTok here. Keith Strand, 91. I think so. But where's it going to go before it recovers? I mean, you could see 10,000. You could even see it below that. If you look at the charts, if you look at all the, you just hit all on whatever platform you look at, and you look at Bitcoin, we're in a dangerous place with Bitcoin right now, because Bitcoin had such a run up. Same thing with the stock market, had such a run up that right now it has fallen, and we're out of floors. We don't really have any more floors at the level we're at right now to catch it on the fall. So basically, picture jumping off of a cliff, but then maybe there's a little rock that you hope to land on right there. Well, let's just say that rock, you miss it. There's a long way down before you hit the ground. And that's where Bitcoin's at right now. It's a very scary place for Bitcoin. I am still buying it and taking positions on the way down, but I think we're going to definitely test some much lower. So you better take your horizon for any cryptos. And I would specifically say Bitcoin and Ethereum should be the only two you're messing with. And even those are risky. Like, there's no intrinsic value. There's no fundamentals on crypto. So you have to understand it's all investor confidence. And if we lose investor confidence, we lose the price completely. But I do think that it will be around. I think that in a long run, how long, don't know. I think you will see it come back. I mean, if you look at the dot-com crash of the late 90s and early 2000s, although it crashed in the dot-com recession, some of those companies made it, and now are the Amazons, the Googles, and all those companies that really were formulated and around during the dot-com crash, but they made it through. The question is which ones are going to make it? Is it Bitcoin that's going to make it? Is it Ethereum that's going to make it? Or any of them going to make it? That's anyone's ballgame. I don't know the answer to that. Let's see. Should I stop contributing to my company 401k? Heels 1919. Great question. I would say, and Tim, yes, I can always talk more about infinite banking. So this is just not really the platform where we talk just about infinite banking, Tim. Tim Norton 3 was here. He wanted to hear me talk more about infinite banking. This is what the F happened. So this is about the markets and what's going on. Wealth webinar that we do every single Wednesday. Stephen Nagy does a webinar every single Tuesday night. That is all infinite banking. The 3-day event, we will be talking a lot about infinite banking. It's just, Tim Norton, this just isn't the show that we do where we talk a lot about infinite banking. So I apologize. I'd love to just talk all about infinite banking, but we got to get some things out of the way when it comes to the markets, Fed actions, and what's coming to everything. If you're in privatized banking, if you're doing infinite banking, you're laughing right now. Because I'll tell you one thing about the infinite banking concept, which is the process, or the specially designed whole lives that we do. They only do one thing: go up in value. That's it. They can't do anything else. And if you apply the process, the infinite banking concept, to that machine called a specially designed and engineered whole life, you've got yourself a wicked combination to make a lot of money in any market condition. And you don't sit there worrying at night, oh my God, what happened to my 401k? But let's get to Heels 1919. This is a very important question, and one that a lot of people, logically, they think, oh, I'm going to stop putting money in my 401k. Do not do that. So Heels 1919 on TikTok said, so should I stop contributing to my current 401k? Absolutely not. Okay. Here's my suggestion for that. Okay. And take this, for whatever, and it's different for each person. Different needs and goals require different answers. So this is a broad-based answer. This is not advice. This is not for everyone. You got to look at this and decide, does this work for your needs and goals? But here's what I would say. Don't stop contributing to your 401k. So when markets go down like they are right now, what you want to be doing is buying or dollar cost averaging into that declining market. And the 401k provides a really nice platform. Same with an IRA or any platform. If you're dollar cost averaging weekly, every paycheck, or a little bit every single month, you're dollar cost averaging down. And that's a really good thing. But you got to make sure that you are positioning your current assets in a safe place. That's the first thing I can tell you to do right there. But with that being said, folks, I got to clean. So therefore, I can jump. There's a lot of great questions here, and I wish I could say here how to answer them all, but I can't get girl and wife and so with that being said, folks, thank you all for joining me for another week of Wealth Webinar. Join us this afternoon at 1 p.m. Eastern for the Wealth Webinar series, and then also at 4:30 for Ask Me Anything. We do lots of shows every week. We're up to 7 live shows. Join us for them. Infinite Banking is Tuesday nights every single week. The Wealth Webinars every Wednesday, and you all can join me and my team and a whole bunch of unbelievable speakers July 30th and the 31st for the live event. And just go to moneyschoolrei.com/July-event. Until next time, folks, have a good day.